The global index that you released a few days ago for Q2 2016, it looks at a movement of 2.1% in prices for Nairobi homes year on year. What is the driving factor right now?
Okay, I think there are a number of things we need to understand about the index first. Primarily, it looks at houses with a value of over 80 million shillings, so it's not indicative of the market as a whole, it's the prime market. Secondly, a growth of 2.1% over the last year is not very high, and in fact that is a growth of only 1.2% in the last 6 months, and in fact a negative growth of 0.2% in the last 3 months. So I think what we're seeing actually is a plateauing off of the prime market. If you were to take Karen, for example, if you were to go back into the early 2000s, land value in Karen was probably less than 10 million shillings an acre. Now we're talking upwards of 50 million shillings an acre. Now, if a developer's buying land in Karen to develop houses for sale, let's say he's spending 50 million shillings an acre on a 10-acre plot. He can put 20 houses on that plot. Each house, he's already committed 25 million shillings in land. So he has to sell those properties for upwards of 70 million shillings. He can't build houses at a value of less than that because the land value is so high. So what that means is that places like Karen are flooded with houses of over 70 million shillings, and that market is saturated. So we've seen in large parts of Nairobi that growth, that step growth has happened, and now it's reached a plateau. It's reached an equilibrium, if you like, where we have now a balance between demand and supply, so it's taking a lot longer for the developers to sell those houses.
Would you say that the slowdown that you're seeing in prices is because we are finally seeing realistic pricing of property in Nairobi?
I think so. Other forces are affecting the market at different levels. I think the diaspora and remittances, are Kenyans who are working overseas. They're sending over $130 million a month back into the country. A lot of that goes into the middle market, so your apartments in Kileleshwa, that kind of thing. But the mortgage market is still very small, so there's a lot to change in the property market. I would say the prime, yes, we've reached an equilibrium. I don't think we have a huge oversupply problem, but developers will throttle back. They'll slow down the rate of development at that prime market as they realize that saturation has been reached there.
80 million shillings is not small money, even by Kenyan standards. Who is buying these houses and why?
Well, I think that's a very good question. I think there are people who have done very well, who are looking for a safe place to put their money. Most of the buyers that we find at Knight Frank are actually wealthy people who are buying to live in those properties themselves. We don't see people buying properties at that level as speculative developments. It does happen, but by and large it's people who are perhaps looking to settle down in a slightly nicer environment, whether it's Karen or it's Runda, those kinds of places. They're looking for secure environments within gated compounds, and so that's where that 70, 80, 90 million shilling bracket is happening at the most.
The global index shows that Vancouver had the highest price gain of up to 36%. In Africa, we are talking about 16% in Cape Town. How does Nairobi compare among the cities that you looked at?
We have been there. We've been up. We were top, actually, at one point in the past, not too distant past. I think that we see these growth spurts in different cities happen for different reasons. And so, yeah, different cities have their time. Singapore, various places come up, come down. It's all about growth. So, it's the place that's growing most rapidly that features high on the index.
For an investor wishing to invest in the prime segment of real estate in Nairobi, what are the factors that they need to be aware of?
I don't think investors are really investing in prime from that sense. I mean, the developers will, certainly, and that's the market that we've been involved in. But you don't get a very good return from buying a single house for above 80 million shillings. I mean, your return will probably be sub 3%. And actually, at that price bracket, you're better off spending that money in a different sector of the market and benefiting from a slightly higher yield and better capital appreciation. If you were to spend 80 million shillings and buying 4 apartments in Kileleshwa, for example, you do a lot better than one very high-end property, in one of these high sectors of the city.
Are we going to see more people willing to invest in these high-end properties within the city?
I think so. Look what's happened to the interest rates. I think that'll have a substantial impact on people's appetite for borrowing. I think I'm hoping the mortgage market will really benefit from that. We have slightly less than 30,000 mortgages in a country with a population of 48 million people. I mean, it's crazy. The mortgage market doesn't really exist here. It's a cash market. So if we can persuade more Kenyans to buy their property, even if they have to borrow to do so, it's very important that they do that, because if you're renting a property, and I've said this many times before, you know, the money that you earn, if you're paying, I don't know, 25% of your salary is going into your rent, that money's just going and it's lost to you. Whereas if it's going to pay off a mortgage, you know, you're benefiting from the capital appreciation, the growth in the value of your property. So as the economy of Nairobi grows and develops and the value increases, you're participating in that value increase. If you take out a mortgage on a property that's worth 30 million shillings, in 5 years' time, if it's worth 40 million shillings, that 10 million belongs to you. And that's your participation in the growth of the city. It's your share of the economic growth. But if you're paying rent, that just slips through your fingers and you miss out on being part of Nairobi's growth, which is very sad.
Finally, let's touch on the logistics report that you announced as well, saying that Nairobi does not have enough capacity, mostly looking at warehousing, and so people are going to build their custom-made warehousing facilities. Sure. What does this mean from a cost of doing business perspective?
Well, I think if you were to look at those global organizations that need state-of-the-art warehousing and logistics space, because we don't have it from this market, they're having to go out and build it themselves. And many of them, once they've built it, will then try and do a sale and leaseback deal. So they'll sell their own property to an investor and become tenants in their own building. And they're having to do that because we don't have that. I mean, what I would like to happen, and what should really happen, it would happen in South Africa, happen in Eastern Europe, elsewhere in the world. Someone will walk into the Knight Frank office in that country and say, this is my requirement, I need 20,000 square meters of high-end logistics space. Give me an agent, we'll spend the afternoon going around and looking at all the space you have. We don't have any, we have none. So what these guys are having to do, they're having to build it themselves. They're not developers, so they don't have the economies of scale. They don't necessarily have the expertise. Sometimes these buildings come out quite expensive. So what we're going to see as the demand grows, because of course Nairobi is a regional hub and logistics is very important in regional hubs, we'll start to see developers develop bespoke buildings for these early adopters, but they'll also start building speculative developments as well, so that we will get to a situation where someone can walk into our Nairobi office and we can spend the afternoon showing them a selection of these properties. They can then choose one. They can be in occupation within 3 months instead of the 18 months or longer that it'll take to build them themselves. So I think this is going to be a sector of the market where we're going to see the most change in the next 5 years.